Billionaires made $4.4 trillion last year and paid a lower tax rate than their secretaries. Not through fraud. Not through offshore accounts. Through a three-word strategy the IRS can't touch. It's called buy, borrow, die. And once you understand how it works, you'll realize the entire tax system wasn't designed for people who earn a paycheck. Let me set the stage with a number that should genuinely make you uncomfortable. A ProPublica investigation found that the 25 richest Americans paid an effective tax rate of just 8.2% between 2014 and 2018. Meanwhile, if you're a single filer making $75,000 a year, you're sitting somewhere around a 22% effective rate. You're paying nearly triple the rate of people worth tens of billions of dollars. And the craziest part? Everything they're doing is completely legal. The tax code doesn't tax wealth. It taxes income. And that single distinction is the crack in the foundation that the ultra-wealthy drive a truck through. So here's how buy, borrow, die actually works, step by step. Let's say you've built a portfolio worth $10 million. Maybe it's stocks, maybe it's real estate, maybe it's a mix. That portfolio is growing at roughly 8 to 10% a year. Now, a normal person would think, great, I'll sell some of those assets, take the gains, and live off the proceeds. But the moment you sell, you trigger a taxable event. Long-term capital gains tax kicks in at 20% federally, and if you're in a high-income bracket, you're adding the 3.8% net investment income tax on top of that. So on $1 million gain, you could owe nearly $240,000 in taxes. That's the cost of selling. That's the price of liquidity for normal people. But here's what the wealthy do instead. They don't sell anything. They walk into a bank or a brokerage and they take out a loan against their portfolio. This is called a securities-backed line of credit, sometimes called a margin loan or a portfolio loan. And because it's a loan, not income, the IRS doesn't tax it. You read that right. You can borrow $300,000 against your $10 million portfolio and owe exactly zero in federal income tax on that money. The interest rate on these loans for high net worth clients is shockingly low. We're talking somewhere between 3 and 5%, depending on the size of the portfolio and the relationship with the lender. Now compare that to the 37% top marginal income tax rate. If you had earned that $300,000 as salary, you'd lose over $100,000 to taxes. But as a loan? You keep every penny. And your portfolio keeps growing in the background, untouched, compounding year after year. Now you might be thinking, okay, but eventually you have to pay the loan back, right? And when you do, you'll need to sell assets and pay taxes then. And that's where the die part comes in. This is the piece that turns a clever tax strategy into a generational wealth machine. Under current U.S. tax law, when you die, your heirs receive what's called a step-up in cost basis. Let me explain why that matters with real numbers. Say you bought Amazon stock 20 years ago for $200,000 and it's now worth $5 million. If you sold it while alive, you'd owe capital gains tax on the $4.8 million gain. That's a tax bill of nearly $1 million. But if you hold that stock until death and pass it to your children, their cost basis resets to the $5 million market value on the day they inherit it. If they sell it the next day for $5 million, their capital gain is zero. They owe zero in taxes. The $4.8 million in gains just vanished from the tax code. Gone. And this isn't a loophole for the little guy. The current estate tax exemption is $11.58 million per individual, which means a married couple can pass over $23 million to their heirs completely free of estate tax. And with the right trust structures, that number goes even higher. So let's put the whole cycle together. Step 1, buy appreciating assets and never sell them. Step 2, borrow against those assets at low interest rates to fund your lifestyle. Step 3, when you die, your heirs inherit the assets with a stepped-up basis, sell enough to pay off the outstanding loans, and keep the rest tax-free. The debt gets cleared. The tax bill gets erased. And the wealth transfers to the next generation almost fully intact. Rinse and repeat for every generation. This is why dynastic wealth exists. It's not just that rich families earn more. It's that the system lets them keep almost everything. Now I know what some of you are thinking. Cool story, but I don't have $10 million. So how does any of this help me? Fair point. But the underlying principles here are not exclusive to billionaires. The core lesson is this: the tax code rewards asset holders and punishes income earners. So anything you can do to shift yourself from the earner column into the owner column is going to save you money over a lifetime. First, maximize tax-advantaged accounts. A Roth IRA works on a similar principle. You pay taxes now, but all future growth and withdrawals are completely tax-free. That's your personal mini version of never paying taxes on gains. If you're eligible and not maxing your Roth, you're leaving one of the most powerful tools in the tax code on the table. Second, think about asset location, not just asset allocation. Putting your highest growth investments in tax-advantaged accounts and your income-generating investments in taxable accounts can save you tens of thousands over a career. Third, understand the long-term capital gains brackets. If your taxable income is below roughly $44,000 as a single filer, your long-term capital gains rate is literally 0%. Zero. That means with the right planning in early retirement or in a gap year, you can harvest gains and pay nothing. That's the same principle the billionaires use, just at a different scale. The system isn't going to change for you. No politician on either side has successfully closed the step-up and basis loophole despite decades of proposals. The buy, borrow, die strategy has survived every administration because the people who benefit from it have the resources to protect it. So your only real option is to understand the rules of the game and play them as intelligently as possible with whatever resources you have. If this changed how you think about taxes and wealth, hit that like button. Subscribe if you want more breakdowns like this every single week. And the next video is going to cover a strategy that most people think is saving them money but is actually costing them a small fortune over time. You won't want to miss it.